Hello, everyone. I'm Ted Oakley, managing partner at Oxbow. And I'm really pleased today to have with us an author of one of the best books I've read in a number of years. I want to show you a copy of it called The Humble Investor here by Dan Rasmussen. And Dan comes to us after working his early career was with Bridgewater, Ray Dalio's firm, and Bain, and then started his own company. He has a wonderful really email he puts out from time to time with great information. But listen, Dan, glad to have you today. Thank you for coming.
Thank you, Ted. It's a pleasure to be here.
I'm going to get right into this book a little bit. And one of the first parts you talk about, which we've always agreed with, is you can't forecast. So how do you feel about that?
Yeah, there's a wonderful story I write in the book about one of the youngest winner of the Nobel Prize in economics who worked in the weather service during World War II. And he was responsible for producing long-range weather forecasts. You know, is it going to rain 6 months from now? And he was doing this research, and he realized that these 6 month out weather forecasts were complete garbage, that they weren't worth anything. And so he wrote up a memo to his commanding officer, and he said, look, we should disband the weather service, because our forecasts are worthless, and you could just use an almanac and you get better results. And he got a message back from his commanding officer, and it said, the commanding officer knows that the forecasts are worthless, but he needs them for planning purposes. And I thought that was such a wonderful line, because I think it encapsulates many of our challenges, and that in some sense we need forecasts to make plans, or we think we need them to make plans, and yet we also know that they're worthless, and that it's really hard to predict the future. Humans have many gifts, but the ability to see the future isn't one of them. And so I think what I'm trying to pose, or the challenge I'm trying to pose in this book, is to say, well, let's almost start from a place of what I call future nihilism. Imagine we know nothing about what tomorrow holds, which isn't far from the truth. How would you act differently? How would you plan differently? How would you behave differently? And what are the implications of that for investing?
Well, and I know, and you also go into in the second sort of maybe second chapter type stuff, is that Wall Street really thinks revenue and profit are predictable, but your idea is that it's not, and you needed to focus on today. You might talk about that.
Yeah, it's funny. There's this wonderful set of studies that look at the persistence and predictability of growth. So, you take all companies and you say, well, let's take their last 3 years or 5 years of revenue or profit growth, rank them. And then does that predict the next 3 or 5 years, or even 1 year? Do the companies that have been growing the fastest continue to grow the fastest, or not? And what these studies find is that there's actually no relationship between historic growth and future growth at all. You might as well just use a coin flip to predict what the growth rates of these companies are going to be. And I think this presents one of the fundamental arbitrages in markets, which is that everybody else is making these forecasts, and they're overconfident in making them. We really don't know the future. And I think, another sort of funny example, people say, oh, so-and-so, they only focus on next quarter. They're so focused on the short term. To which I respond, well, maybe that's because the short term is the only thing you can get any edge on. And the minute you get out to a year or 2 years, who the heck knows? I mean, think about how hard it would be if we said, how much money is going to be in each of your bank accounts 3 years from now? Would you have any sense? And you're the world's leading expert in you. And so if you then apply that to companies, think of the hubris required to say you can forecast, all the financial statements for some Fortune 500 company. It's just crazy. And so what I'm trying to say is, gee, let's, instead of trying to make those forecasts knowing they're going to be wrong, let's instead back up and say, what if we don't know? How would we act today?
I have to mention something on that, and it's not my interview, but I did want to mention this. I've had two partners in another company, not Oxbow, that for 35 years, every January, we've sat down $100 in the pot each. You have the Dow Jones, the 10-year Treasury, oil, and you bet you put $100 in the pot for that, and then there was a fourth, I can't remember. But what we do is with $100 in, and guess how many times anybody in 35 years has gotten all four? Zero. Now, sometimes you might get three or you get two, but it just goes to show, because what you talk about in the book is focus on today. All I have is today. And I think, don't you think investors forget about that you need to look at where you are today?
Yeah, I think you need to look at where you are today, and you have to think about. I have a mentor who says, once you know what your principles are, it's not the decisions that are hard, it's the consequences. And I love that line. I mean, and I think it's right. You say, what are my principles today? Let's say the future is unpredictable. Any set of things could happen. Am I acting today according to the right principles? Have I followed a logical process and approach? Such that when the unpredictable future happens, I'm not going to be so surprised I have to change my entire investment approach, right? If your investment approach is built on you seeing the future, getting some estimate of the future right, you're going to be disappointed so often. You're going to end up changing your investment process every 3 to 6 months, and then you're never going to have the sort of stability or long-term view that you need to consistently make money over long periods of time.
Well, and I'll switch gears here. And so I'm reading your book, and there's this chapter, and I said, I can't believe Dan Rasmussen wrote this because this is what we've been thinking a long time, and it's very contra Wall Street. And that is your chapter on private equity being probably the single biggest mistake today for investors. And I'd really like for you to talk about that.
Yeah, it's remarkable the level of consensus optimism around private equity. Now it's changing now.
Yeah.
People are sort of realizing the problems. But I'll start with just the sizing, which is very interesting, right? So private companies, there are many more private companies than public companies. Just something you'll hear very often in private equity marketing. What they don't tell you is that the aggregate economic size of the private companies is much smaller than the aggregate economic size of the large companies that are public, and that's actually grown over time. So a larger share of the economy is public than it almost has ever been in the United States. And I think a way to think about this is like, yes, there are a lot of dry cleaners, but it takes a lot of dry cleaners to add up to one Facebook. So who cares that there are more dry cleaners than there is one Facebook, right? The size is what matters, not the number. And if you add up the sort of aggregate economic activity, you'd come to a number for how big private equity is relative to public markets of about 2 to 4%, right? But you're seeing many endowments and foundations in particular who have been the most susceptible to the industry propaganda, taking their private market exposure up to 40%. Which I think is like 10x, at least 10x overweight the size of this portion of the market. And I think the even scarier thing is the misunderstanding of the risk, because not only are these really small companies, but they're also using a lot of debt. One thing we know about debt is that it increases risk and volatility, and when bad times come, you're more vulnerable. So putting a much larger share of your money into a much smaller companies with much more leverage, in my view, is a very risky thing to do. And I think that it makes it even worse is the illiquidity. You're trapped in these things for 10, 12 years. You can't get your money back. And what we've seen recently is that the distributions have dried up, that the private equity firms can't sell their companies. And I sort of joke, if you've been trying to sell your house and you haven't been able to sell it for 3 years, it's probably not worth the price that you're listing it for, right? Like your price is wrong, right? And so that's what we're seeing in private equity, right? They're claiming their returns are good, but their returns are based on the marks, but they can't sell the things that they're marking it at. So what are the chances that it's actually right? And I think it's just a tragic mistake. People have trapped their money in this very high fee, very risky corner of the market, thinking that it was not risky. Now they can't get their money back.
And and illiquid too. And I see where the Wall Street and the consultants sell this to the family offices, and we see a number of big pension plans and some people that we manage part of that will have 30% in private equity. Personal belief is they don't know what they own. I don't know how you feel about that.
That's exactly right. I think, first of all, people are surprised to hear that private equity is small levered companies, right? They think, oh, these are big companies or they're high quality companies, right? I often hear, these private equity backed companies are high quality businesses. But actually, if you look at their fundamentals, they're generally much lower margin. They're much smaller, right? Like, I mean, a bigger companies are almost all more diversified. They're safer. They're less risky. They have more assets, more lines of business. You go into smaller companies, of course, they're more risky, a lot more fragile, lower quality, lower margin, et cetera. And I think that people are sort of seduced by this idea that maybe the private equity guys are going to manage these companies better, or they're operating them in a better way. To which I say, but all the people that worked in private equity, they're all former investment bankers, right? Like, well, where in investment banking do you learn how to run a Midwestern industrial company? Is that like year two of making PowerPoints, where they suddenly teach you, this is how to run
Yeah.
a large manufacturing business, or is it more likely that what they're really good at is putting debt on the balance sheet and doing acquisitions, right? And so I think there are just a number of implausible things that people believe that private equity is less risky. Well, how can it possibly be less risky? That the companies are better run. Really? The bunch of bankers are running the companies better than the people that ran them before. It's just not worth the fees. It's not worth the headache, and people have gotten duped into it.
And it's interesting, you mentioned that, Dan. A lot of these young MBAs I talk to from really some of the major schools, they come through Austin. We talk to them, and I'll ask a lot of them I ask what you're doing. Well, I'm in private equity. I said, well, have you sold anything yet? Any of the companies? No, I know we're waiting. They're not really at a mature stage yet. And I'm thinking to myself, you probably don't know what you're doing. More than likely. But anyway, it was that I always think that if people read, they ought to get this book and read that particular chapter because you put a lot of great info in it. But moving on, you also talk about Wall Street and how they just buy them and forget them, and they generally just forget it. You just buy it, and this is going to work out. You don't have to worry about anything for the next 20 years. And there's a lot of that been going on the last 15 years, but you might mention that about how you talk about that.
Yeah, I think that there's a great tendency to it's easiest to sell what's working, right? I mean, in some sense, if you back up, when we think about investing, right? Why are we investing? Well, we're investing to make money, right? We want to grow our wealth. And so the greatest sales pitch, the most convincing sales pitch to most people is whatever thing has done the best recently, right? Whatever is the best recent returns, because from a utility perspective, that seems like the thing that best accomplishes our goals. But unfortunately, the way the world works, right, is that the world, is surprising. It's unpredictable, and it's almost never the case that the thing that's just been working the best for the last year or two is the thing that's going to work the best forever. And so, what Wall Street does is they churn through, constantly pitching and selling the things that have been working the best for the last 2 or 3 years ago. And the themes are constantly changing. And I think what you need to do is, you have to step back from that and say, hey, gee, I'm not going to listen to this constant cycle of marketing of these fads and new trends. The fact that they've got a new trend this year is probably indicative that the one they pitched last year wasn't all that good. And I think that it's that sort of discipline and skepticism that I think leads to much better investment decision making.
And Dan, you mentioned that, knowing what's going to happen tomorrow is you can't, but you mentioned in there that you can know statistically whether you're extremes of the market both ways, cheap
Yes.
or expensive. And you might mention a little bit about that because I think people forget about that.
Yeah, I think so. So my view of investing is that it's not a game of analysis, it's a game of meta-analysis. It's not what you think, it's what you think relative to what the rest of the market thinks. And there's a wonderful story about a Greek ship owners that I tell in the story that Greek ship owners, when shipping prices are really high, they look out and they say, well, if I had 3 times the number of ships, I'd be making so much more money. So what I should do is I should go order a bunch of ships from the shipyards. The only problem is it takes 2 to 3 years for the ships to get built. So they go out and they say, oh, based on my model, I should be able to, run these ships very, very profitably. And they go out and they order a bunch of them. And then 2 or 3 years later, the ships arrive. And they look out and they say, well, what's going on with shipping prices? And they say, well, shipping prices are in the tank, right? I mean, it's just been a disaster. And they say, well, how could that be? And they say, well, there's an excess capacity of new ships that have come on the market. And I said, well, how is there an excess of new capacity? I said, well, so many people put in orders 2 or 3 years ago that now the ship prices, there are too many ships and the ship prices are down. And this is called competition neglect. People forget that competition exists, that, whatever the things that you're analyzing, the conclusions you're coming to, are often the same things that other people are studying. And they're often reacting to them in the same way that you are. And so in my view, the best way to invest is to think not, what is my analysis tells me that sort of first order, wow, shipping prices are high, I should order new ships. It's to think, well, probably everyone else is doing that too. And so what I really want to look for is periods of excessive optimism or excessive pessimism. What are things that everybody's talking about? What are the things that I go to a restaurant and my buddy is bragging that he invested in, right? That's probably the stuff that's overbought. And conversely, the stuff that your grandmother is calling you and saying, hey, should I sell this stuff? It's been a disaster. I don't know why I got into this or whatever, right? That's probably the stuff that everyone is, too pessimistic on. And so I think what I write about in the book, one of the sort of the best opportunities and the sort of easiest way to see this is that the best opportunities in anyone's investing career, no matter what asset class you're in, will come in times of crisis. And if you look back, March of 2020 or March of 2009, or, there are these great periods where if you had money and you could have gone out and bought assets, you had a sort of once in 10 or 20 year opportunity to make money. Just crazy excess returns by doing relatively simple and rational things. And those things don't come along that often, but they do come along in times of crisis when everyone's excessively pessimistic and excessively fearful. And so I write a lot about in the book about planning for that and thinking about, how do I, we should be avoiding the things that are oversold, sort of that people are pumping that are excessively valued. Of course, we should be avoiding those, but we should also have a plan to buy the things that are excessively out of favor. And crises represent the best opportunity to do that.
The one good thing about you writing this book, Dan, is you actually manage money. A lot of people write, they have opinions, but they're not in the trenches. Okay. So I love to interview people that actually manage money because they have to make that decision every day. And you mentioned about what do you think people, you just mentioned about what people are thinking. What do you think generally people are thinking now?
Yeah, I think we're in a moment of change, Ted. I think if you reround to December, I think there was a lot of confidence. I think probably the single biggest thing, of course, private markets, people were very positive about private markets. And then within public markets, I think people were very optimistic about the United States and US large cap tech. That was the thing that people thought would kind of go to the moon. And crypto also during that period was, at its heights. And now, and I write about the book about geographical diversification, that, you shouldn't put all of your eggs in one basket. And I think, when you look at how richly valued the US was getting and some of these growthy themes like crypto, et cetera, again, one of the problems is they've done so well for so many years, and that was sort of supportive of an easy thesis that these things are always going to work. But I think the sort of second order thinking was that, wow, things internationally are quite cheap, quite attractively valued, and everyone's pessimistic about it. Everyone says, Europe's a museum and Japan's a nursing home, and these aren't robust economies. They've got no growth companies and no tech, and why would you ever invest there? And all of a sudden, you see this year international stocks opening up a massive performance delta against the United States, which nobody would have thought of in December.
That's true. And I'm going to switch gears on here, and this next topic is one that you talk about extensively, and I would have venture to say a lot of professional investors don't know this or use this, and I'm talking about the high yield spread. And just for all those that want to know out there, it's a spread between what I'll call junk or high yield and the Treasury. But you mentioned that's one of maybe that's your number one indicator, but you might talk about that a little bit.
Yeah, it's a wonderful economic indicator. And if you think about why it's such a good indicator, is first, it's measuring something very real, which is how banks and lenders are pricing risk. And when they're pricing risk, really what they're pricing is default risk, right? Is a company go bankrupt and not be able to service their debt? So it's a very sort of a cynical and quantitative analysis to say, what's the likely bankruptcy rate across, risky companies today? They're not thinking about growth. They're not thinking about, some wild optimistic story. It's pure bankruptcy risk. And the second thing that makes it very valuable is that it has real world implications. It impacts the world. So when spreads go up and the cost to risky borrowers goes higher, those risky borrowers have a harder time refinancing, which in turn makes their borrowing costs go up even more, right? The bankruptcy risk go up even more. And similarly, when you're thinking about the junk bonds are what finances a lot of the risky activity in the economy. And we want risk taking in an economy, right? It's part of capitalism. We want people to take risk. We want them to open a new factory. We want them to, make some acquisition. We want them to try to grow, hire new people, take on debt. This is all good. Um, but when spreads go up, all that activity gets slowed down, right? Because it has to meet a higher bar in order for it to happen. And so what you want to look at is both the level and direction of the spread. So the level of the spread is telling you, what the sort of current state of the market is, right? So you can look at spreads today, and they're call it in the low 300s. That's telling you the economy is generally fine, right? There's no crisis right now. There's no economic pain that's being felt, right? And by the way, that spread has been pretty low since COVID. The only time it spiked was around the banking crisis when Silicon Valley went out, which was a big risky moment. But other than that, it's been stubbornly optimistic about the economy, and it's optimistic right now. The other thing you want to look at is the direction of the spread and how it's moving. And one of the things you note is actually in the last month or so, it's gone up a lot. So it used to be at, in the sort of high 200s, and now it's in the low 300s. That's actually a big jump. And you'd say, well, yes, the economy is still in a very good place, but the price of risk just jumped. And we should be careful because of that. And so I watch the spread all the time. I look at it every day to try to say, hey, gee, let's ground myself in where the level of the spread is, right? There might be some scary headlines, but if the high yield spread's in the 300s, there's probably not all that much to worry about. But on the other hand, I do want to look at the change, right? And when that rate of change starts to accelerate, I should be more cautious.
And Dan, in I think one of your most recent pieces that you put out, you talk about how, and I don't know what you think about private. I think I know what you think about private credit, but also that maybe private credit starts to confuse that situation a little bit.
Yes, that's right. So private credit is really interesting. So the high yield market is called $1 trillion, and now private credit, I think, is $2 trillion. It's a massive portion of risky credit, and it's all lower quality in the high yield market. It's lending to smaller companies that are able to issue bonds, or it's issuing more leverage at worse terms, lower covenants, et cetera, to bigger companies. And it's exploded in the past 10 or 15 years. And the origins of it were really that the banks didn't want the risk of doing LBO lending. And so they said, hey, we're not going to do LBO lending anymore. So these private credit firms started up or expanded to sort of fund the buyout boom and to fund private equity. And they're generally lending at significantly higher rates than even the high yield market. And so one of the things that's made the high yield spread a little bit the high yield spread was always the canary in the coal mine, right? These were the lowest quality companies, and so you could sort of see risk in a very sensitive way. Now, so much of that bad risk has migrated into private credit markets that you can't see, that it makes the spread a little bit worse. It's still a very valuable resource, but one of the things that you do want to monitor more so than you did in the past is what's going on in private credit, which is of course harder to do because it's private.
Well, and it's interesting. I've asked a couple of private credit people in funds. I've said, look, you're telling me that you have companies that are paying you 10.5 to 11.5, but they're really great companies. And my second question back is, well, if they're such great companies, why aren't they borrowing from the bank? And why wouldn't I borrow at 7.5 if they're so great? And I get no answer on that.
Yeah, well, that's the funny thing. I always joke that nobody ever gets it, but I say lending is the second oldest profession. We know exactly what the price of lending risk should be because we've had thousands of years of lending to companies.
Yeah.
And there's one thing that higher interest rates mean. Higher interest rates mean higher predicted default rates. That's the only reason you're lending at a higher interest rate. So the intersection of companies that are really great companies and companies that have to borrow at 12%. Is about the same as the intersection of friends of yours that are really great borrowers that are paying 12% mortgage rates, right? Like if your friend came to you and said, hey, can you give me a mortgage at 12%? You'd say, absolutely no, right? Like I'd have to be crazy. I don't, all I knew was that that you thought 12% was a good rate for you. All I know is that you were a terrible, terrible borrower, right? And that's true of companies too. And I think I call it fool's yield. It's people are willing to get suckered in by high yields without realizing that the reason the yields are high in an efficient market is because they're pricing high default risk.
And I have to give you credit. About a year ago, and I want to say that I stole this graph from you, but you put out a great graph showing the rating of paper all the way from top rating down to junk. And you showed the initially how it started out with a coupon and how it ended up with the actual yield after all these defaulted, et cetera. And I thought that was the very best thing that I'd seen somebody put out on that. And it made a lot of sense. You know, explain that to people though.
Thank you, Ted. Yeah, this is the idea of fool's yield. So if you're looking at fixed income, you start from sort of AAA rated paper, right? And let's say today that's yielding sort of 3%, and you go to double A, and maybe that's yielding 3.2, and then single A is 3.4, and right. What you see over long periods of time is as you go from call it AAA to double B, which is the highest quality part of the high yield market, as your yield goes up, as your coupon goes up, your realized return goes up. But after double B, your yield goes up. You know, it might go up to 10, 12%, but your actual realized return goes down. So it's showing efficient markets, right? On the one hand, efficient markets might say, that every bond, no matter what the yield, should have the same total return, right? That's sort of the maximal view of efficient markets. What we see here is a little bit different, that at least in the higher quality credit, you get a little bit of incremental return as you go down the rating spectrum. But once you start to get stuff that has really juicy, attractive yields, that stuff is fool's yield. Essentially, it sucks people in. They end up, it's really hard to know the difference between a 12% and a 13% yield and to get that really right. So it tends to be that people are saying, well, 12's a lot, I'll just take that. And then the eventual default rate on that type of paper ends up being high enough that you end up worse off than you just bought something that yielded 6%.
Yeah.
So it's a view into sort of the way capital markets work in the fixed income markets, right? And we always have to remember, right? It's the same competitor neglect, right? We should be thinking if we see a really high yield, we should run away. We should be very cautious because, again, fixed income markets should be more efficient than equity markets. The only reason something should have a higher yield is that it has a higher predicted default rate. And most likely that default rate is, you're going to experience that at the most surprising, worst possible time for your portfolio.
Well, it's just a really good piece. And in the last, I'm going to shift one item here. You talk about gold and timing with gold to a degree, but what are your thoughts on that?
Yeah, so I think, everybody needs low risk assets in their portfolio, right? We can't put all of our money in high risk assets, right? We want to have a large equity allocation. We can't have all of our money in equities unless you're, 25 years old or whatever in your retirement account. But so what do you do with your low risk money is a challenge that people face. And treasuries or bonds seem like one good alternative. But the only problem is that when there's inflation, those bond returns can get whacked. And you saw that over the last few years. And so what's your alternative if you are worried about inflation but want a low risk asset? And the only answer is gold, because gold is also very low risk. It has about the same volatility as treasuries. However, it responds positively to inflation. Now, in your low risk assets, you're not going to make much money, right? That's not the point of owning them. But there's a wonderful a paper that shows that the price, the annual salary of a U.S. Army captain today, paid out in gold, is exactly the same amount paid out in gold that a Roman centurion earned in 0 AD. So for thousands of years, gold has maintained its purchasing power in terms of being able to pay for a soldier, for example. And so you can know that putting money into gold, you're going to get your money back in a inflation adjusted way. And so I think that using gold as a strategic asset within a portfolio and thinking about, gee, if I'm worried about inflation, that gold's a better low risk asset for me than fixed income. And then I can sort of time that based on my views on inflation. I think it's a very sensible way to approach portfolio management. Now, of course, there are people that never want to touch gold, and I get that, but I think that that it's probably underallocated and underappreciated in institutional portfolios.
Well, but for sure today, because if you look at the percentages, they're very, very low. And so you make a comment on one of the kind of latter chapters about strategy, that you should design a strategy for making money without, and that's been something we've really espoused, without the huge drawdowns. And I think people have forgotten that, by the way, because of the last 15 years, but you might talk about that just a bit.
Yeah, I think these, I'm a big student of behavioral finance. And one of the things that you see is that when your portfolio goes down a lot, you make worse quality decisions. All the behavioral biases are exacerbated. And so there's a tremendous value in having lower drawdowns and lower risk because it enables you to stick with your plan for a longer period of time. And thus avoid the sort of catastrophic risk. I know some very smart people, for example, I know a very, very smart real estate investor who in March of 2020 sold all of his investments, right? All of his investments and went to cash in March of 2020, right? And then he started to get back into the market by buying Zoom stock, right? Because he thought, well, that's a sign that's going to really work. And then, of course, Zoom stock tanked as the vaccine was released. And you just think, wow, he was in the wrong portfolio prior to March of 2020, right? He didn't have a plan, he hadn't thought about it. And I think that this is why you need a diversified portfolio. This is why you need to focus on risk mitigation. This is why you need to consciously think about avoiding drawdowns and also planning for when the drawdown comes. How am I going to go on the offensive rather than on the defense? But all those things are important because behavioral biases drive our decision making, and our decision making is ultimately as important as our investment strategy. And so having this lower volatility, lower risk type of portfolio allows us to make better decisions and thus stick with things for the long term.
And I've always said, if you have one portfolio down 50% and the other one down 15, you have to make like 4.5 to 1 to get back to break even on that. I think people forget about that totally, how much that you can't afford to have the really, really big drawdowns. And a question for you, and I'm not certain you mentioned the book, but I'd like to know your opinion on it. It seems as though today that people are very, very highly invested in stocks. I'm talking about all ages, especially older people. How do you feel about it?
Yeah, I think there are two things that are going on. One is probably over allocation of stocks, and now I think if you go back to the 2010s, there was a period where that sort of made sense, right? When rates were at zero, and there was no inflation on the horizon. So you said, well, I don't really want to own bonds because they're not yielding anything. I don't want to own gold because I don't think there's any inflation risk. So it was a struggle to find alternatives, and so I think a lot of people that went into private equity, which is forgetting that it was just equity, and so they just their alternative was just more equity, a different package. But now, we're back in a world where there are alternatives, where actually the yields on fixed income are decent. There is actually decent inflation, so gold is interesting, right? And there are a whole variety of strategies that are interesting again. And yet people have retained their massive overweight to equities. But I think even more concerning, and we've seen this, there are elements of passive investing that are very good, right? Lower fees, easy access to beta, proliferation of funds that you can access, whatever theme you want to access, right? Those are all good things. But one problem is that when people have gone passive, they've generally almost dumped all the money in the S&P 500, right? That's been sort of what passive means. And I think that the risk there is that about 80% of the money in Vanguard's equity money, for example, about 80% of that is tied to either the S&P 500 or the Vanguard Total Market Index, which is totally not diversified. It's not diversified across geographies. It's not diversified across asset classes. It's just pure U.S. equity beta. And I think if there's, the biggest mistake I see people making today is over allocating to private equity. The second biggest mistake is just thinking that the S&P 500 is all you need to own, and being massively over allocated to that versus all the other alternatives, whether that be international stocks or that be other asset classes. And I think that, nothing grows to the moon, and we're at a place where U.S. equity valuations are quite stretched. And I think it's worrisome.
Well, I'm going to finish up with a thing you said in your last chapter, which is, and I think people forget about this, but your statement is this: uncertainty is always with us, and you need to remember that. Is that right?
Exactly. And I think that it's funny that people say uncertainty is rising. You just say, well, we were uncertain before. Maybe we're just paying more attention to it now.
Yeah.
And I think you want to make your investment approach robust to uncertainty, robust to surprises. And that can mean using tools like diversification, where you say, gee, because I own so many different things that respond in different ways to different things, I'm safe. Or it can mean planning explicitly and saying, hey, I don't know what could happen, but we're going to experience a financial crisis, so I should be prepared for what I should do if that happens. But having a framework where you say, gee, the world is totally unpredictable. And I think Dennis Hassabis, who founded DeepMind, did this big study where he found that the neural mechanisms that are involved in forecasting are the same ones that are involved in memory. And so what ends up happening is we forecast what recently happened. It's just like, if you were a caveman, right, and you find, water along one trail, you remember that trail, and when you want water, you follow that trail again. But you apply that investment approach to investing, and it leads you to all the wrong conclusions, right? You just chase performance, chase what recently worked. You invest, you forecast through your memory, and you're driving with the rearview mirror. It's a terrible way to invest, and too many people do it. And so, trying to reorient and saying, hey, just break the rearview mirror, stop looking at it, and instead say, I know I'm driving blind, so how am I going to change my decision making?
Well, Dan, I want to thank you much, and I'm going to show this one more time. It's The Humble Investor, and by Dan Rasmussen. Now, I will tell you, it's one of the best books I've read in probably the last 10 years on investing. It's written by Dan, who manages money. And Dan, you might just mention, if people want to see your info and get things that I know you put out things from time to time, best place to go for that at Verdad.
Yeah, if you go on X, or what used to be Twitter, at VerdadCap, and we've got a little link there where you can subscribe to our email newsletter, which goes out once a week.
And it's an excellent piece, by the way, well written. But Dan, thanks so much, and we appreciate.
Thank you, Ted.
Investing with it very much. Thank you.
Thank you so much.
Hello, everyone. I just want to say, if you like this video and you want to see more of this type of information, because we really try to get the information that you don't see from anybody else, then be sure and click on subscribe, and you'll see more of what we do here at Oxbow.